Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 391 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about investor behavior, and specifically different types of investors that there are, right? Because I want us to be very self-aware. I want us to be understanding about what we have the slant to do, what we have the predisposition to do, and be able to act or create strengths where there are none in our investing lives, and then capitalize on the strengths that we do have in our investing lives. So I think this is very important for us to know who we are, know what we are, and then I'll share with you what I think I am of these four different types of investors behaviorally. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, in really all facets of life, I believe that self-awareness is vital. I believe it's vital to know who you are. I think it's vital to know, what you may do in certain circumstances. I think it's vital to know, what makes you do what you do, right? What part of you is wanting to do something versus not wanting to do something in a specific situation relative to other people, right? I think it's important to know those things. It's important to be self-aware. And when it comes to our investing, it's never more important to be self-aware than during major market downturns. And so I want us to understand that in this particular type of market that we find ourselves in right now, even though we got a good little bump in share prices on Friday, that we still need to know who we are. We need to know what type of actions we have the predisposition to take, and we need to know this. That way we can better prepare ourselves for the next time that a major correction or a crash occurs. Then you can know where you need to focus your energy and focus your time as an investor in order to get you to do all of the things that are correct, because there are principles to investing, right? There are things that work to investing. And these principles don't necessarily create the behavior types, right? We don't get these principles and then, think about them in different ways, and that's what makes us the type of investor that we are. We come as the type of investor that we are, and then we try to make those rules fit what we are as an investor. And sometimes we even just say forget it on the rules and just say, hey, I'm just going to do what I want to do, or we don't ever learn the investing fundamentals. And so again, I just want you to be aware of who you are. And then I want to share with you guys who I am investing wise and exactly what I think that means for me, and how I should react to that on a day-to-day basis when it comes to my investing life, right? And then also something like this, information like this, it can help your financial advisor, right? If you know these things about yourself and you're working with an advisor, hopefully that advisor tries to get to know you in this way, gets to know who you are before investing your money. And in doing so, that will allow them to have a better idea as to, one, what you can take risk tolerance wise, two, what is going to be required of them on a fundamental level when it comes to creating for you the income that you need, or growing your money at a certain clip, or just preserving your capital. And then ultimately it's going to impact the way you and them do business together, the relationship that you guys have with one another. Okay. So we will jump right into the four behavioral investor types. And even if you think that you hear who you are in one of these, you may be surprised when I say another one. And so just stick around for all four. So we'll start with the first. And the first is known as the preserver. Okay. A preserver is an investor who places a great deal of emphasis on financial security and preserving wealth rather than taking risks to grow wealth. Such investors are guardians of their assets and they take losses very seriously. Preservers are often deliberate in their decisions and sometimes have difficulty taking actions with their investments out of concern that they may make the wrong decision or take too much risk. They instead prefer to avoid making decisions and sticking to the status quo. Preservers often obsess over short-term performance in both up and down markets, but mostly down markets. And they also tend to worry about losing what they had previously gained. This behavior is consistent with how preservers have approached their work and their personal lives in a deliberate and cautious way. Now, this is a very, the reason I would say this is number one is that this is a very common type of person, right? I've ran across many a person that was a quote unquote preserver. And these people, I think that some of what they deal with is not just this idea of I'm very risk averse and I'm very cautious, but I also think that they deal with a lack of education around something like the stock market. Yes, they may be naturally slanted towards being cautious or worried or not wanting to take on too much risk, but a lot of, especially in the market, a lot of not taking risk, a lot of worrying about account values, a lot of worrying when markets are down, which a preserver would definitely do, comes from a lack of knowledge. It comes from a lack of time in the market, a lack of experience when it comes to your investing life. So I might argue that a preserver just needs to learn more. And they may need to spend more time understanding bear markets and understanding corrections and understanding what the market does, right? And maybe through a more, pragmatic approach, a thoughtful, factual approach such as that, then you can make a preserver understand why things happen the way that they do and not make them do anything rash when the market's down. Because we've talked before, one of the worst things you can do when the market is down is sell, right? And these are the types of people that will absolutely do so. Now, older investors often behave in a way that is aligned with the preserver behavioral investor type. This is natural. As we age, certainty of cash flow becomes paramount. As such, it's common to find preservers focusing their wealth on taking care of their family members and future generations, especially funding life-enhancing experiences such as education and home buying. Because the focus is on financial security, preserver biases tend to be dominated by emotion, relating how they feel, rather than focusing on cognitive aspects relating to how they think. Wealth level may also influence preserver behavior. I think this is key. So if you feel like you're a preserver, listen to this. Wealth level may also influence preserver behavior. Although not always the case, many preservers that have gained wealth want to preserve it, and they therefore change their attitude towards risk after gaining wealth. This is especially true when an investor has been through a crisis that has threatened his or her wealth, like in 2008, when the S&P 500 dropped 37% for the year. The emotional biases that can affect preservers' ability to attain their financial goals are loss aversion, status quo, endowment biases. Preservers can also display certain cognitive biases that relate to the same orientation, namely anchoring and mental accounting, right? So we'll just talk about a few of these things here. So loss aversion for the preserver. A loss aversion is somebody who they hate taking losses, right? They're not just averse to risk; they are averse to losses, right? They absolutely hate it. This is when the losses are asymmetrically, so not symmetrically, not the same as equivalent gains would be to them in a mental context, right? They think about equivalent losses way worse than they think about the gain. So that's what loss aversion would be, and that's what the preserver would look like, right? They obviously want to keep the status quo. They don't like to change. They don't want to change. They just want to get done what they need to get done. Now, they also have this idea of endowment bias, right? This is an emotional bias and it's inconsistent with standard economic theory, which asserts that a person's willingness to pay for a good or an object should always equal the person's willingness to accept dispossession of the good or object. In short, people who exhibit endowment bias value an asset more when they hold the property rights to it than when they don't, right? So they value the things that they have in their hand, right? That would be another characteristic of the preserver. And then they, take on these ideas of anchoring, right? Anchoring basically being, when you're required to make an estimation, people generally begin by envisioning some initial default number, right? An anchor, which they can adjust up or down to reflect subsequent information and analysis. This is anchoring, and this is an information processing bias, right? Basically, all that we're talking about here is when it comes to, certain values in their investment accounts, certain prices for their investments, they will anchor to those, and that will create biases in their decisions. So the preserver is probably somebody you know. The preserver is probably multiple people you know, and it says that the preserver can come along with age, and I think that's probably true. But I think also that it's just natural for people of an older age to want to decrease risk. Even myself, who doesn't see myself as a preserver necessarily. I know that when I get older, I know that when I am going to retire, that there are going to be times when it's okay to take some risk out, right? It's not going to be important to stay fully invested all of the time. And so I think even though there are some age ideas here, I think the predisposition to be a preserver is something that you naturally have, okay? So that's the first type. That's the first type of investor, the preserver. The second type of investor behavior is being a follower, right? A follower investor is passive and often lacks interest and or has little aptitude for money or investing. Furthermore, follower investors typically do not have their own ideas about investing. Rather, they may follow the lead of their friends and colleagues or whatever general investing fad is popular to make investment decisions. Often their decision-making process is without regard to a long-term plan. They sometimes trick themselves into thinking that they're adept or talented in the investment realm when an investment decision works out, which can lead to unwarranted risk-seeking behavior. Since they do not have their own ideas about investing, followers also may react differently when presented more than once with the same investment proposal. That is, the way that something is presented or framed can make them think and act differently. They also may regret not taking part in the latest investment fad and may end up investing at exactly the wrong time when valuations are the highest. I don't know about you, but I know a lot of people that are like this, right? And I think all of us have a little bit of follower in us, right? We have a little bit of this, if we hear that there's a fad, we hear that there's something going on, we want to be a part of it, right? We want to be a part of it, and we want to do what we can to get the returns that we can get. Now, again, the follower is going to lack interest in money or investing. Again, I think that we all know people like this. We all know people who, and it may be yourself, who lacks the interest, or maybe you lack the overall understanding of money or investing. But being a follower is also very dangerous, right? It's dangerous because without the knowledge, without the understanding, you're still acting, you're still doing something, and that's dangerous. It's dangerous to make the wrong decisions when you don't have the full information, right? I can't imagine somebody who has very little knowledge of the concepts that I talk about on the show going out and making certain investment decisions. It just doesn't make a whole lot of sense to me. Now, the follower can be an effective investor, right? You can be an effective investor and not have just all the knowledge about investing, right? I think that you can be an effective investor if you just passively invest over long periods of time. But the follower is not somebody who typically does this. They are going out and they're doing risk-seeking behavior. They don't have an investment plan. They're easily swayed, right? All these things lead to the people who are very speculative in financial markets, and then at the first sign of downward pressure, they're out of there, right? They move along, and those are not the type of people who we want to be investing. We don't want people to be here today and gone tomorrow with their investing. We want you to be a long-term investor. And so for a follower, it may be more difficult until you take a little bit more of an individual stake in your investing. Now, one of the key challenges of working with followers is teaching them how to refrain from overestimating their risk tolerance. An investment may appear so compelling that they jump in without considering the risks. Advisors need to be careful not to suggest too many hot investment ideas. Followers will likely want to pursue all of them. Some followers don't like or even fear the task of investing, and many put off making investment decisions without personal financial advice. The result is that they maintain, often by default, high cash balances. Followers generally comply with professional advice when they get it, and they try to educate themselves financially. And that's what you want, right? You want them to latch on to good financial advice. The problem is that they could get advice that is not such good advice and latch on to that as well. They just follow the leader. They just follow the person that they feel like knows those, the particular things that are, going to do best, that are going to provide the best returns, or that sound the best, sound the most complex, sound the most, like they're real professional, right? And again, this is a danger of being a follower and not having the financial prowess, because you can be duped, right? You can be duped into buying investment products, purchasing things that are not going to be best for you over long periods of time. And you're also going to be in a position where, otherwise you're not really going to be so interested in investing, that you'll have, a lot of cash setting aside, and then, you'll just wildly speculate on things and probably end up losing money in financial markets and then being scared to get back in later on, right? So being a follower can be very dangerous to your ability to build wealth over the long term. Now, followers' biases tend to be cognitive, relating well to how they think rather than emotional, relating to how they feel. Biases of followers are recency. So the recency bias is a very common bias in financial markets, right? The recency bias occurs when people more prominently recall and emphasize recent events and observation than those in the near or distant past. And this makes me think of people who put money into cryptocurrency, right? They think of, the great returns of the short term, and maybe now you would think of the, crashes of the short term, or the volatility of the short term. But while things were going up, while there were, there was major upside being had, then they forgot about the crashes. They forgot about the volatility of the asset. Investors were at the mercy of recency bias. Then there's also hindsight bias, right? So looking behind you and saying, oh, well, you should know based on, what happened in the past, and we can, make decisions in the future. There's regret aversion, right? These followers, it's basically FOMO, right? They have this fear of missing out. They also have a framing bias, right? And this framing occurs at both the individual investor decision-making level and the macroeconomic level. And this is something that is very common among investors that don't know a lot, right? And we'll get on to this here shortly. And then they also exhibit this idea of cognitive dissonance, which is the idea that humans tend to stick with the ideas they already believe to be true. It's very common and very human characteristics, and the concept is ever present in the world of investment decision making, right? So you just stick to the things that you already think are true and don't worry about anything different. Now, the third type of investor behavior is the independent. Now, an independent investor has original ideas about investing and likes to get involved in the investment process. Unlike followers, independents are quite engaged in the financial markets, and they may have unconventional views on investing. This is the contrarian mindset. However, it may cause independents not to believe in following a long-term investment plan. With that said, many independents can and do stick to an investment plan to accomplish their financial goals. At their essence, independents are analytical, critical thinkers who make many of their decisions based on logic and their own gut instinct. They are willing to take risks and act decisively when called upon to do so. Independents can accomplish tasks when they put their mind to it. They tend to be thinkers and doers as opposed to followers and dreamers. Unfortunately, some are prone to biases that can torpedo their ability to reach goals. For example, they may act too quickly without learning as much as they can about their investments before making them. For example, they may mistake reading an article in business news publication for doing original research. In their half-ready, full-on pursuit of profits, they may leave some important stones unturned and could trip themselves up down the road. Independents' risk tolerance is relatively high, and so is their ability to understand risk. Independents are realistic in understanding what risky assets can and do go down. However, when their investments go down, they don't like to admit that they were wrong or that they made a mistake. Sound familiar? Independents often do their own research and don't feel comfortable with an investment until they've confirmed their decision with their research or some sort of corroboration. They are comfortable collaborating with advisors, though typically using advisors as sounding boards for their own ideas. Independents are often comfortable speaking the language of finance and understanding financial terms. They aren't afraid to delve into the details of investments, including the costs, fees, and making of investments. And if you don't know this already about me, I am an independent, right? That would be my type of investor behavior. I have a contrarian mindset when it comes to investing. I am analytical. I'm a critical thinker. I think based on logic, right? I act very decisively. I'm not afraid to take on risk. I'm very willing to do so. And yes, I am prone to some of the biases, right? I am prone to make a decision before, I get all of the information, right? I may act too quickly just because I'm like, hey, let's just do it. So I may do that. That's something that is very common of me when it comes to making mistakes, right? I just act quickly and then deal with the consequences later. I may leave some important stones unturned that could trip me up down the road. That is true, but another part of being an independent is that I'm constantly doing my own research. So some of the stones I may leave unturned, I may eventually get around to and do my own research and figure things out. I do understand that risky assets go down, and they do go down. I understand, financial terms, financial lingo, and I will use it as such. So this is who I am as an investor. And I feel like being an independent is a great place to be. But just like all of these other types, there are downsides. Being an independent can put you in a place where you think that you know more than you actually do, right? You can get a little cocky in your ability to make financial decisions. And I try not to do so. I try to always be humble to the idea of new financial instruments, new thoughts, new ideas, new methods, all these types of things that could, potentially work and potentially be better than what I already know. Now, the behavioral biases of independence, there's cognitive conservatism, ability, confirmation, representativeness, and self-attribution, right? These biases are some of the ones that I kind of laid out above, and I'm not going to just dive back into all of those. But I feel like this is 100% me. I feel like this is a lot of people who do work in the financial sphere, right? They are independents in some way, shape, or form. Now, some people who work in the financial sphere aren't comfortable doing their own research. They're not comfortable, looking at things from a very objective view. They, want to hear what other people have to say. They want to hear people's opinions. They want to just learn from other people. And I do like to learn from other people, but more than anything, I'm out here trying things out as I go and trying to make the best decisions based on the experience that I have and the information that I have at the time, right? So that is the independent. Again, none of these are better or worse than the others, but they are all very different, okay? Then the last type of investor behavior is being the accumulator. All right. The accumulator is an investor who is interested in accumulating wealth and is confident that he or she can do so. These clients have typically been successful in some business pursuit and believe in themselves enough that they will be successful investors. As such, they often like to adjust their portfolio allocations and holdings to market conditions and may not wish to follow a structured plan. Moreover, they want to influence decision-making or even control the decision-making process, which potentially can diminish an advisor's role. At their core, accumulators are risk takers and are firm believers that whatever path they choose is the correct one. Unlike preservers, they are in the race to win and win big. And unlike the followers, they rely on themselves and want to be the ones steering the ship. And unlike individualists, they usually dig down to the details rather than forge a course with half the information that they need. Unfortunately, some accumulators are susceptible to biases that can limit their investment success. For example, they may be too confident in their abilities. Since they're successful in business or other pursuits, why shouldn't they be successful investors? And overconfidence sometimes leads them to think that they can control the outcome of the investment, even though it may be full of unknown risk. Accumulators can also get their spending out of control at times due to the wealth effect of having created assets that can lead to lifestyles that are more extravagant than prudent. Accumulators may also make investments based on how the opportunities they come across resonate with their personal affiliations or values. Accumulators' risk tolerance is quite high, but when things go wrong, discomfort can be very high. This discomfort may arise not only from financial loss, but from the blow to their confidence and the realization that they cannot control the outcomes of investments. Some accumulators can be quite difficult for advisors to, build close relationships with because these clients are making their own decisions rather than relying on the advice and counsel of their advisor. These clients are entrepreneurial and often the first generation to create wealth, and they're even more strong-willed and confident than individualists. Left unadvised, accumulators often trade too much, which can be a drag on investment performance. Furthermore, they are quick decision makers, but may chance higher risk investments more so than their friends. If successful, they enjoy the thrill of making a good investment. Some accumulators can be difficult to advise because they do not believe in basic investment principles such as diversification and asset allocation. They are often hands-on and wish to be heavily involved in the investment decision-making process. They tend to display the biases of overconfidence, self-control, affinity, outcome, and illusion of control, right? They have the illusion of control over their investments. So, there are things about the accumulator that I do see in myself, but when I think of the accumulator, I think of high net worth clients who, and it's just the classic case study of like the attorney or the doctor who has a lot of professional success and then thinks, then why in the world can I not be a good investor? And they don't necessarily want to follow a structured plan, but, invest in individual stocks or individual securities or more risky securities because they think that they can win. And then they like to dissociate themselves from the losses and relish in the wins, right? This is definitely this type of person. Now, we've seen the good and the bad in all these types of people. And I want you to know that wherever you are, whomever you are, it's not likely that you change, what your character is, what your characteristics are as an investor. But it is likely that you can change certain behaviors that may be holding you back, that may be keeping you from being the best version of yourself that you can be. I just think, and I will continue to believe so, that the best way to become a better investor, become better financially, is just to gain knowledge, right? Gain knowledge and put it to practice, right? Don't just read books to read them or articles just to read them or, take classes just to take classes, right? Actually apply things to your life, get the experience, work on things and learn new things all of the time. I know I don't expect any of you to be as immersed in your investing life or financial life as I am, but I do expect you to, take a very vested interest because this is a very important part of what your financial life is going to look like down the road. And so if you are, just kicking the can down the road today, you're going to eventually have to pick up the can later on, and it may not be very easy to do so. So hopefully this helps you to be more self-aware, to understand who you are as an investor and as a financial manager. And maybe, I can help you to, push you into different areas of your financial life based on, what type of behavioral investor you are. So just remember that self-awareness is key, and use this information, this descriptive information, to create some prescriptions for yourself to be the best investor that you can be over the long term. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.